Hey everyone, welcome to today's Property WOD. Let's start that again.
That's fine.
Hey everyone, welcome to today's Property WOD, our workout of the day. I'm Michael Beresford from OpenCorp, and what we're going to be talking today is in response to quite a few questions that we get around purchasing with emotion, and specifically how that can be an issue with respect to when investment purchases are based on something you like as opposed to something that's effective. You know, it's really easy to do. People think, well, if I like a property, then clearly others will like it and want to live in it because everyone's just like me. The fundamentals are slightly different. So I'll share with you an example on the board about how you cannot achieve the financial gains when you buy based on emotion as opposed to buying smart. But just first, I guess a case study from my experience. A few years ago, I talked to someone about investing, and they were convinced that buying something blue chip that they liked in the suburb where they lived, it was a couple of streets away, was going to be the best investment. We talked about risk, we talked about buying older property, we talked about maintenance, we talked about exposure to higher amounts of debt, all of those kind of things. But they were convinced. They went and bought a property in the Melbourne suburb of Bentley, so that's about 12 kilometres from the city, south to southeast, and they bought that for $680,000. Now, about 10 months after they bought it, the tenants moved out, and they were left with a loan for just under $650,000, plus their line of credit to cover deposit and costs, because the property needed re-stumping. It was old. They'd bought it at a period in the market where there hadn't been enough growth for them to be able to re-borrow the $30,000. The equity hadn't been created to allow them to borrow that money to pay for the repairs, and they didn't have the cash to do it. So they ended up selling that property at fire sale for $615,000 because of the issues that it had with it. So they just couldn't afford, obviously, the exposure to such a high level of debt without having a tenant. That's the kind of stuff that can go wrong. Old property can look beautiful. Maintenance risk is the major risk with your cash flow when it comes to investing. Okay, so let's look at cash flow and let's look at how you can use it most effectively to maximize the wealth that you create. Okay, now if we think about a typical emotional purchase, okay, the typical property that I see most people buying are 2-bedroom apartments in inner city locations. Let's call them blue chip property. They're aspirational areas. I call them bragging rights areas. You know, love to have a property in Elwood for argument's sake. Can't afford, the 1.5 million to buy your own house there, but it sounds sexy having an investment. That kind of property is going to cost conservatively $650,000 to buy. Okay, and when you look at what the rental yield is on that, when you look at what the tax benefits are and so on average interest rates, that property is going to be costing you a bit over $300 per week out of your pocket to hold. Okay, now if that's the available cash flow that you've got, that's a fair amount of money. That's 15 grand a year. So if you haven't got that much, obviously you're not able to buy one of these. But if you do, then all of that cash flow is going to be tied up in this one property because that's what it costs to hold. So you've got $650,000 of asset value growing for you over time. Okay. Now, if we look at what a smart investment looks like, under the median house price, let's say it's $500,000. Okay. Now, as you've heard me say many times on these WODs and Caminal and in the books, we talk about $100 a week as a worst case holding cost on average interest rates. Okay. But for this example, we're going to bump it up and say that each property costs you $150 a week to hold. Guys, investing is about something that happens in the background with your life as your lifestyle continues moving forward. Okay, it's not something where you have to shelve your lifestyle, no holidays and eating cat food for the next 30 years to create wealth. is not going to inspire you to be able to reach those goals that you want. Okay, so it needs to be affordable. So let's be conservative and say 150 per property. If 300's the balance, then obviously that can be spread 2 lots of 150, allows you to hold 2 $500,000 properties. Okay, so that gives us $1 million of asset value growing for us over time. Okay. Oh yeah, that's great, Michael, but inner city grows at a higher capital growth rate. Well, not necessarily. That's one of the big property myths. Supply and demand drives growth. Fewer people can afford this than can afford this. But for this example, let's say that the inner city blue chip property grows at above average rates of 9% per annum, where the smart investment only grows at 8% per annum, which is below average. Okay, 8.7% is the 50-year average in Australia in terms of capital growth for residential. Now, this is the key thing, guys. Okay, because of compound growth and that growth on growth on growth, if you did nothing else in a 10-year period, okay, so no big portfolios here, just holding 2 of these for every 1 of these. If you let that go for 10 years, then in 10 years' time, the smart strategy, based on a lower growth rate but holding more asset compared to this, for the same cash flow out of your pocket, gets you over 600 grand in front. So there's the takeaway point, guys. If you're going to get emotional about anything with investing, get emotional about the result. Okay? Don't be passionate about what you buy building blocks to create wealth through compound growth that allow you to spread your available cash flow over several investments, mitigating risk at the same time. So stay tuned. Next time we're going to be talking about how to calculate compound growth so you can understand exactly how I've arrived at these figures. Stay tuned for that. That's up next. Until then, bye for now.